Welcome to this episode number 29 of your next trade, called today Apple Coronation. So last week I made a mistake. I thought that the coronation of Charles III was happening on Monday. It happened today. So my first mistake as of last week. There is another one more important. But as we have been underlying for the last few months, it is very much clear that the market, the equity market, the stocks have been very much driven by a few names, 5 to 10 names, which are the FANG, which is Facebook, Amazon, Apple, Microsoft, and Google. And as we can see in this first chart here, Apple is now about to be making new highs versus the S&P, versus the SPY. So here, this is the chart since 2017, and we can see the massive outperformance of Apple over the last few years. So this is an Apple coronation. Let's try to understand now if there is a match between the price action of Apple and what is really happening in terms of revenues and EPS for the company. So let's start with the first chart here, which is in black here. We got the Apple prices on the left-hand side, and on the right-hand side, we get the EPS for the year. And as we can see, it peaked as of last year. This is the red chart, and it has been coming down. So if we look over the last 3 to 4 months, we know now that most EPS and revenues have been downgraded by the sell side and the buy side, by the consensus, by quite a lot. And despite this equity market, and names like Apple have been doing very well. So Apple is up roughly 30% for the year. Now let's look at the second chart, which is here, looking at how the consensus is for the next few years for the top line. So for 2023, we expect the top line, the revenues, to go down by 2% for Apple, and then another 6% and roughly 7% in 2024 and 2025. So what is very much clear for those big FANG names, it's not about revenues and revenues growth going forward. It's mostly about cost cutting and generating free cash flow and EPS. But looking at the EPS, the revenue estimates here, and the EPS estimates, you can see what has been the trend, how the expectations have been over the last year or so, really coming down. So don't tell me, so for market participants or people, in the community, people on Twitter are telling us, revenues are going to be better, EPS are growing. This is not what is happening. We are going into EPS going down year on year, revenues that have been struggling, and the expectations have been lowered. So if we look here at the sales revisions for 2023 here, from 1 month ago and 1 year ago. So 1 year ago in 2023, the revenues for Apple expectations were 7% higher. And for 2024, it was 5%. What about the earnings? Actually, earnings were 8% higher for the 2023 and 4%. So actually, what they managed to do very well, those big tech companies, is to cut costs. What is clear as well for the Apple coronation is they are going into a new business, which is clearly threatening the normal financing business, and which is, making the winners and the losers of the regional banks crisis. So we know as well that the regional banks in the US have been struggling to keep their deposits. Why? Because, if you tell people that they can be putting their money at work at 0%, they will be flying for places where you're going to have higher yields. And as of the last month, Apple has been offering those high yield accounts, which are yielding 4.1.5% in the US, and has been creating flows into the company, and to I think it's roughly 1 billion over the last week. But that tells you that those big techs are getting bigger and bigger. So there is much more concentration in terms of revenues, in terms of businesses that they are doing. And more importantly for us as investors, the chunk or the weighting that they are making both in the Nasdaq and in the S&P is bigger and bigger. And it's not necessarily that, revenues are better, much better, or the expectations have been on the way up. It's just that there is scarcity in the names, and we are all looking at those few names. Finally, looking at this chart here, this is the Apple PE. And as we can see from January onwards, it's not again because the EPS revenues are going up, it's because the multipliers, the multiples here from Apple went from 20 to 30 times. So not much about earnings growth, but very much about PE multiples going higher. And now we have the market for, let's take the example of the S&P, where the earnings are not going to be growing that much, but actually the multiples have been on the way up. One of the reasons that we can underline for this to be happening is obviously yields. We are talking more importantly 5 to 10 years mostly have been on the way down. So that means when yields are going down, very often multiples are going higher. It's going to be pretty much tough if you think about two things: earnings not growing and probably inflation a bit sticky for the multiples to go much higher. So that was a bit for the coronation of Apple. What about the year-to-date asset performances? The picture is very much the same as before, where we get the US indexes, the S&P up roughly 8%, 17% for the Nasdaq. In Europe, we are around 10 to 15%. Emerging markets are not performing that much. In terms of FX, same picture as before. Dollar has been weak for the year, 3% down roughly. Crypto very strong. Commodities through WTI and copper a bit struggling, especially for the WTI. Gold has been the big outperformer recently, so it's trading above $2,000. And as we can see into the week-to-date asset performances or later, is the gold miners have been doing very well. So what about the week-to-date asset performance? Sorry, it's a bit of a misleading picture because we had, as very often, the trend has been the same. We are selling at the start of the week, and then we are ending the week very well. So the trading range for the S&P is very much the same, but as we're going to see for charts, we are now really knocking at the top range for both the Nasdaq and the S&P. So picture same here with euro, dollar currencies. Interestingly, WTI very weak, as we're going to explain later some of the factors. Now looking at the year-to-date industry's performance, what is interesting is now the new king are the gold miners, which is obviously the second derivative of the gold, which has been performing very well. And that tells you about the sentiment for many market participants. These fly into, let's say, not quality, but risk off. Other end of the spectrum, sorry, we got the regional banks. But I would like to look more into the week to date and what has been happening for the week. Again, gold miners really, really strong, roughly 6%. Regional banks still very much weak for this week. So Tuesday was the market sold off. S&P, Nasdaq on risk of contagion for some other regional banks. Yesterday, Friday, and was very strong, so we had a massive bounce on many names, as we're going to see. So what about the sector performance? I'm interested in that one mostly these days for understanding the price action. So energy, normal. When WTI is struggling, we're going to have the XLE. That is a bit of an issue. Same for the bank with the XLE. For the KRE, KBE, for the banks, telco as well. But IT, a small winner, so a bit of outperforming. But what is interesting as well is looking at the S&P, it's more or less like anything that is cyclical is doing like the S&P. Moving into the rates, looking at the US 10 years, we're at 3.4%, so very much the same as of last week. So not much of big moves in the rates. We are waiting for the next inflation numbers that will be coming on Wednesday and Thursday. So we're going to have both the CPI and the PPI in the US. The yield curve is around minus 50 bips, looking at the 2 versus the 10. So if we are when the recession will be knocking at the doors, quickly we're going to go from minus 50 bips to minus 20 to positive. So when we start to see a steepening, this is when we are getting closer to the recession. So second mistake that I did last week, looking, so we know that we moved from the euro-dollar contract to the SOFR contract. I made this mistake, and I'm glad that someone on the community jumped. So instead of looking at the September contract for June, I was just looking at June. So everything was wrong by 3 months. So I just copy and paste the formula, and I didn't even bother looking. So my apologize. And more importantly, I moved to the Fed funds rates. It's not as liquid as the other contracts, but it's easier for me to present what are the expectations for the Fed and the Fed policy going forward. So the Fed funds rates, where are they? They are 5.08. We know that the Fed hike rates this week by 25 bips. That was expected. So what's going to happen going forward? Going forward, we're going to have roughly, so this is the hike, and then we have the cut. So mostly market is now pricing almost that we are at the end of this hiking cycle. Going forward, what is very much interesting, if we look at the December 2023 expectation versus now, okay, 508 versus your 442, and that gives you minus 66 bips. In other words, let me do the translation, that the market is pricing the Fed to be cutting rates between now and the end of this year by 66 bips, or 0.6%, which is roughly 25 bips. So that's quite a lot. What the Fed said, what the Powell said this week on Wednesday, they are not expecting to be cutting rates. So there is a huge mismatch between what the Fed is saying, which is we're going to stay on hold at best, or we are still monitoring inflation and don't expect us to cut rates. And the market is saying it's even more than a Fed pivot. The Fed will be cutting like quite drastically going forward. And as we can compare here, the last in blue versus what was priced as of last week, you see the change. So the market, when it goes down, that means yields are coming down, that we are expecting the Fed to be cutting even more rates as of yesterday versus last week. So quite a big move, even more for the market. Everyone is a bit scratching his head here on what the Fed is saying. Why should we have such a cut? If we're gonna have such a cut, that means, in other words, that recession is coming big, and we are talking into H2. I think recession is coming in H2. Is it going to be the end of the world? I'm not that sure, but to have such an aggressive cut, that means more than a mild recession that the Fed is talking about. What about the VIX now? Looking at volatility, so we are at 17% on the VIX versus the week to date before at 15%. So interestingly, as we can see, or not, I mean, it's a bit small, but we went to 20% roughly after the Fed and the combination of what the Fed was saying, and as well the regional banks were. So we went above 20%. So there was a bit of a freaking out for the market over this week, and that was the same for the short-dated VIX. So I would like now to jump into technical analysis, looking at the S&P first, as always. So we know that the big level is the 4200. Everyone is watching it. What is interesting is if we compare the bit of a sell-off. I mean, it's not a sell-off, that when we went down at the beginning of March, we went down to 3850, whereas these days it's much higher. It's much more difficult for the market, for the S&P to go lower. So the consolidation is done in very few, in a very much smaller trading range. I think, bulls are pointing out that, this consolidation is making clear that we're going to break above the 4,200. I still believe that the market breadth is very poor, that the volumes are very poor, and it's very much driven by options. What about the Nasdaq? So we are close to the top of the range. Again, when you end the week on a positive like this, that gives you there is the bit of traction. The Russell. So we had the nice bounce from Friday from the regional banks that helped a lot, but the picture is very much the same, underperforming massively versus the Nasdaq. And now I'm interested in that chart, which is the regional bank. So you remember or you don't remember, but I think it was in March. When we did a similar episode, I was pointing out that, this 40 level, 44, there was a good chance that we'll be testing, much lower in the 30s. So it is still in the cards, but, for those of you who do a bit of dodgy technical analysis, the way I call it, you see the big volume that we had on Thursday. And when there is a pattern that is called when you get a gap down and a gap up, like we had from Thursday on Friday, it's called an island reversal, which normally is very, very strong. From experience, island reversal, they don't work that many times, but that's still something to be looking at. I think the issue of the regional banks is not solved at all. When you tell people that they can be putting money with King Apple or some, even interactive broker at 4%, when in the meantime, their deposits yield 0%. That is clearly a no-brainer for them to be moving money. And that doesn't mean that this is the quality of the assets that the regional banks are holding are very bad. So it's very different from what we had in 2008, 2009, which was really a story of bad quality of the balance sheet. Right now, it's not as much the case. There are still the issues of the CREs, but it's across the sector. But looking at the deposits, that is a different story. Emerging markets, so China / still the same, not much. Looking into Europe, as I said before, a bit underperform recently the US. So jumping now into the CL1. So CL1, very interesting chart. Where we had a big move on Thursday. So that will be here. You see the big wick for this candle. The reason why it happened is Japan was closed on Wednesday, Thursday, Friday. And very much what happens when the Japanese market is closed is you have very poor liquidity. So we know that overall the markets are not showing great liquidity. We get after the close on Wednesday, both on the FOMC first reaction, and some news on the regional banks, the market overreacted. So if you go with a bad tape and a bad liquidity, what happens is the market, open at 68 something, low liquidity, it goes to 64. But the reality, you should be always looking at what has been the volume down and looking at stuff like volume profile or VWAP. And you could see that there was not much traded below 67. But more importantly, always check, your calendar. When are the markets open, the big markets? And obviously, when the US is closed and you go into Europe, you're going to have overnight the Asian market, and it's mostly about Japan and how this liquidity and if the markets are open or not. Copper, similar picture. So, for people that are putting online or on the community that China is hot. Don't look at CL1, don't look at copper, because commodities are telling you a different picture. So I don't think the story is for a very strong economy worldwide, but that is my view. Euro dollar consolidating after a big move. So market, if you look at stocks, if you look at commodities, if you look at FX, and as we looked before, if you look at the 10 years in the US, we are looking for the next catalyst. So we have been consolidating. There is a lot of barking on social media between longs and shorts. You can be barking, you don't make that much money out of it, and you lose a lot of energy. Dollar yen, similar picture. We had a bit of a move, but we are waiting for the next catalyst. And finally, similar to the first slide that I had, looking at Apple versus the SPY, so looking at how Apple is outperforming, we might have a breakout now or double top, depending on where you see that. And I want to end with the SOX index, looking at semiconductors. And as I've been saying over and over, the market is looking for new leaders, and we are all been struggling to find those new leaders for stocks. So what about now jumping into this, what has been happening for the week? So we had the FOMC meeting on Wednesday. So that was the sell-off that we are here on Wednesday. Before that, we had a bit of a sell-off on the S&P. So this is for the chart for the ES, for the S&P futures. What has been happening from Tuesday onwards, more noise or more realities going into the regional banks. So I've been sending, pointing out at all those regional banks that could be in trouble. I don't think that the overall size of the sector or the industry is an issue, but that means, again, if the customers are flying for more yield on the deposits, this is just something that this is a structural short, unfortunately, for those companies. I'm not crying for the end of the world. It's just reality. So looking at what has been happening, FOMC meeting on Wednesday, I will say that there is a big fight that will be coming soon. First, we got the debt ceiling. We know that the US will be running out of money based on this threshold, this ceiling, probably beginning of June. So market is more and more driven short term. So I don't know when it's going to be hitting the tape big time, but it might. But more importantly, or importantly as well, we get the from the FOMC meeting. It was clear that Powell was saying, we are data dependent, that there is still inflation. His expectations are actually for no recession, but in the meantime, 5 minutes later, he say we might have a recession. So he is divided between no recession, mild recession, and you could say on one hand that what has been happening so far with inflation they have been very, very wrong. So the expectations were not as accurate as where inflation was. On the other hand, you can argue that the US economy is still doing pretty well, but there is a big fight coming because as we've seen before, there is a mismatch between what market participants are expecting from the Fed and actually what the Fed is saying. So next one, which is going to be important, this is the regional banks, and that's going to be very much of a driver. This week we had the PMI services and manufacturing across the world. I'm just giving you this chart, which is the JP Morgan World Manufacturing and Services. So in blue we get the manufacturing, and in orange the services, and you can see over the last 3 months to 6 months the big divergence between services and manufacturing. One of the reasons is obviously the destocking from manufacturing, but the world has been slowing for the manufacturing, and that means as well that China, again, which has been a market driver or a GDP driver for the rest of the world, is not working as much as before. So then after what we had the NFP on Friday, which is here, where the expectations were, where the numbers were a bit better than the expectations. I think it was roughly 250,000 jobs created versus 180. But this number is always very much volatile, and plus the revise were a bit lower. So overall, numbers good, but there is a bit of volatility in the numbers. Unemployment rate is making new cycle low, which is at 3.4%, and more importantly, the S&P reacted very well. But I think it's very much again options driven. You get the options here, 41.50. That has been the level, for many options calls, and Friday was no different. Many market participants played big time the calls, and we went slowly but surely into the 41.50. So big move from roughly 1.5% to 2% yesterday. Finally, earnings, what has been the week? So we had a massive week, roughly 40% of the S&P that came with the earnings. So overall, that is coming. These data are coming from Refinitiv. 79% of those companies reported so far actual EPS above estimates. So that is just above the 5-year 77%. And for the earnings, 7% above estimate, which is below the 5 years of 8.4%. So that means, in other words, that this earnings season has been good, but versus history, that is not crazy good. Keep in mind that 4 months ago, the expectations were 6 to 7% higher for the earnings. As we started the call, we have seen that Apple expectation was much higher, and that was true for all the markets. So price action overall pretty muted actually for the reaction. So not a great reaction across earnings. If you dig a bit further, actually, if you went short the companies that were struggling on the day, you will have been making money into the earnings drift. So, whereas in Q1 not much was working, and this season has been better for earnings momentum. What about the catalyst going into this week? So we are gonna have a big week in terms of inflation. So we got the CPI on Wednesday in the US and the PPI. We know that inflation has been coming lower. Now the question is this inflation going quickly below the 2 to 3% level? So that's going to be interesting because it has been ticking up a bit. I'm interested here looking at the CPI day and the PPI day for the S&P. So if you look at the CPI, market has been behaving pretty well on CPI day, whereas on PPI day recently, price action has not been so great. So we have the CPI on Wednesday, where so far recently market has been behaving on the way up, and the day after we get the PPI. We do have some earnings, so the earnings season is almost over after this week. We're still gonna have some names, but as you can see, it's only 12.5% market value for this week, and most of them we're gonna be on Monday and Tuesday. Then it's really drying up. We do have like the Bank of England decision rate on Thursday, but we are a bit light in terms of big macro numbers, except inflation. So inflation still matters and matters a lot. Looking at the moves that are expected by the market participants for the S&P, we're expecting 1.5%. Looking at the money straddle versus a 1.6% last week. So not crazy move if you think about how the market has been moving in the past. So VIX at 17%, realized volatility has been coming down. So finally, I'm interested in that part, which is the Fed speakers, which now the blackout period of the FOMC is over. So we're going to see more headlines about Fed speakers talking about inflation expectations into H2. And as well, the earnings season is almost over, the share buyback will come back in force. So that is more or less for the drivers. Still, the market is waiting for new catalyst. We have been consolidating and talking about stocks for quite a long time now, with low volume, with a lot of barking between people. Don't waste your energy on barking too much. Think about ID generation, that is more important. If you want to have maybe some help on ID generation, you have the 4x4 video series or the mentoring. I had a lot of people coming from mentoring, so actually 4 to 5 people over the last couple of weeks. So if you are interested in the mentoring, you should be in a hurry, or you could that later in the future. If you want to join the trading community, this is for free. This is on Discord. We got channels for newcomers, and we got channels for more advanced people that did the 4x4 or the mentoring. And if you got questions, send me a question. We can have a call, and I'll be hopefully helpful in my answers. So this is for the week. Big week for inflation, CPI on Wednesday and Thursday. And long live the king. And I see you next week. Bye-bye.